Welcome, everyone, and thank you for joining us, whether you're here live or watching the recording. Today's discussion is focused on starting and scaling an investment counseling firm in Canada. I'm Joe Millot. I'm a partner in the financial services practice at Verecan Capital Partners. We're an independent investment bank with offices in Vancouver, Calgary, and Toronto. Before we begin, I do want to do a quick plug. I publish a LinkedIn newsletter called The Future of Wealth Management. It's free, and subscribers hear about events like this before everyone else. I'm just going to put the QR code in the top right-hand corner here. I would love it if you would subscribe if you're not already. Okay, let's jump straight into it here. This session is for founders, operators, and owners who are making real decisions about starting, scaling, or exiting an investment counseling firm. Some of you may be thinking about going out on your own, registering a new firm. Others may already be part of an existing platform and looking to scale. And of course, some of you may be considering transitioning ownership altogether. My goal is that everyone leaves the session today with practical, actionable insights. And to do that, I'm joined by three industry leaders. Mamit Bhatia is SVP and head of Wellington-Altus Private Counsel, the investment counseling arm of Wellington-Altus. Colin White is president and CEO of Verecan Capital Management. And of course, to ground us in the regulatory landscape, we're joined by Noah Billick, partner and director of regulatory funds and compliance at Renno Co. So over the course of this discussion, this session will cover a few things, and I want to make sure everyone gets some value from this. The registration process and regulatory requirements for IC firms, how to design a compelling value proposition, funding and financing from launch through scale, technology decisions that will future-proof your firm. That's particularly important in today's AI age. And growth strategies, whether organic, M&A-driven, or a combination of both. We'll leave time at the end for questions. Please feel free to submit them at any point during the event here via the LinkedIn page, and we'll address them in the Q&A. Let's start with introductions. Mamit, I'll turn it over to you first.
Thanks, Joe, and hello, everybody. Appreciate you spending time with us today. My name is Mamit Bhatia. I recently joined Wellington-Altus to lead its private counsel business. Most people are familiar with Wellington-Altus Private Wealth, the CIRO entity, which has an 8-year history of exceptional growth. And we're now focusing on bridging some of the gaps like operations, technology, succession that Joe mentioned in the investment counsel space. In a few months, I'm going to have 30 years in the industry, working with asset managers, trust companies, and private counsel businesses. Dating myself there, but looking forward to today's discussion.
And Colin, over to you next.
I remember when I used to only have 30 years experience. So I'm on the other side of 30 years experience. I started giving financial advice before there was computers. So that's how far I could date myself. Yeah, so I'm the CEO and president of the Verecan Group of Companies, which includes Verecan Capital and Verecan Asset Management. We are a group of advisors that left a CIRO firm and formed our own entity, I guess, back in 2023. So we have kind of been through the journey and have the scars to prove it and stories to tell. So I'll wait for Joe to prompt me and I will begin telling stories.
And finally, Noah.
Well, I guess I'm the most junior of the bunch. I've only been doing this for about 20 years. I'm a lawyer, and my practice is entirely devoted to regulated financial services firms. And obviously, a lot of those are investment counseling firms. I've worn a lot of hats in the industry, but I've mainly been a chief compliance officer at a variety of firms. I was also an advising representative myself with the book of business, and I've also done some recruitment of advisors. So we've sort of touched a little bit of everything. And now what I do is I help firms get set up, get compliant, stay compliant, and scale. I think I bring a lot of that business experience to my legal practice, and that makes my approach a little bit more oriented toward finding the right trade-offs between compliance and growing the business.
And that's a very good place to start, Noah. We're going to kick off with the registration process and the regulatory landscape. So many advisors aspire to own their own firm. and you're pretty much at the cutting edge of the registration process, both good ones and bad ones, I imagine. What are you seeing when it comes to registering and the timeline to do so?
Right. Great question. And often one of the first ones I get, because in most cases, and I think, I think some of the other participants on the panel will have more insight than I do on this, but when advisors make the decision to start their own firms, often they're pretty anxious, right? There's something they've been thinking about for a long time, and then suddenly there's sort of a trigger. And unfortunately, the reality is it's still a fairly slow process. Now, it does depend to an extent on the jurisdiction, right, of the primary regulator. I'll focus on Ontario since that's really still where most of them are. And right now, I think for a pretty clean application, you're looking at 6 to 9 months, and that's not really counting the amount of time that's required to get ready, right? Prepare financial statements and policies and procedures and disclosures. I think the key is having a very clean application, right? And not every application is perfect. Sometimes, you find, things are what they are and you have to deal with them. But to the extent that there are things that are within your control, that's where it's important to get it right. So don't have gaps. Understand what your business model is before you submit your application. Make sure you understand because switches really delay the process. Understand your sources of capital. Don't submit, pie in the sky financial projections that are unrealistic. Have your service providers set up in advance. All of these are things that will help to smooth the process. But I think having good advice and good partners is really, really key in ensuring as smooth an application process as possible.
6 to 9 months, that sounds actually quite good. Colin, you just went through the registration process. What was it like for you and for Verecan, and how did you navigate it?
Sounds like somebody who's never really gone through it and had it really mean something to them. It was closer to the 9-month mark, but if you add in the time that it took to get ready to get to that point, you're well over a year, because there's a lot of decision making that goes into it. And people give grief to the Canadian regulatory environment, but it's got a basic fundamental issue that everything's provincial. And if you're trying to do like multidisciplinary, like, we also do insurance. So that's a different regulator. So we're now dealing with 20 regulators, and we were trying to do it largely nationally. So that's just difficult. Like, those are not interprovincial trade barriers. Those just means there's just different jurisdictions you're dealing in, and they all are slightly different. And they kind of have agreements. So there's kind of a passport system, but then there kind of isn't, because some of them have different questions, and it changes. So I mean, the information that we're getting today is more up to date from the lawyer in the room. That's more up to date information, because we found that even like getting people registered has changed by jurisdiction and over time. So it's really important to get a really good stable of professionals who've got very specific experience in that area to make sure you get through it. We just went through registering with the SEC in the US, and that was a breeze. Like, we did that in under 60 days. I think it was closer to 45 days. And it was funny because there was like, oh my God, you deal with the SEC? It's like, yeah. It's like, that must have been terrible. Like, no, like I'm in an abusive relationship up here. That was dead easy, right? So having registered in the US, and maybe some of that's our experience up here, like we've been through it, so we understand regulation and stuff like that. I spent 4 years serving on the National Advisory Council to IROC back in the day. So understanding a little bit about how regulations work, why they work, what questions you can ask, what you can't ask. And, so we had some good experience on the team, and we had some good advice, but still, it's over a year easily if you're going to, from soup to nuts, to get something launched.
Yeah. And you talked about, the anxiety of registering and it taking that long. The thing that I hear from a lot of advisors who are considering going out on their own and registering a firm is that there's a real delicate balance between when do you resign from your current dealer firm, and then obviously appoint yourselves as on your new firm. So how did you navigate that particular issue?
With some really good legal advice. So I think it's very much contract based. So our contracts at the time were 45-day contracts. So we had to give 45-day notice. So leading up to that process, and again, I'm not the expert. You don't have my chief compliance officer on the call. But for a while there's certain aspects of it that were, the full resume went in, but it was blinded. So like there was no name attached to it and again, the lawyer's nodding up and down, so that must be okay. But that's where you need some good advice on how to get things up and running. So setting up separate entities, having members of your team that are not part of the regulated entity who are working on the project. It can also be very important if you've got the scale to do that. But you got to pay real close attention to the regulations, because it is very important you establish. You don't want to go offside in the process of getting set up, because that's a really tough way to start life. I've talked to members that have launched firms and got announced their audit the first day they were live. That was an indication that they pissed somebody off during the approval process and they were in the soup. And so you don't want to start with that kind of blemish on your record or be digging out of a hole, because it's fraught. But you bring a good point. It's very anxious as well, because by the time you've made a decision to do something like this is very exciting. It's very scary. You're basically, if you're an existing advisor making the change, you're shutting down a business and then restarting it and hoping everybody shows up. On its face, that's stupid. Like that's a completely idiotic thing to do. Now, it's for all the right reasons in many cases, but you are shutting down a business and trying to reopen it at great cost, expense, and with a great amount of risk. But to answer your question more directly, go back to the different contracts. Like we had a 45-day contract. Other places have no contact or no compete, or they've got a 90-day contract, or they've got a 10-day contract. And that's where having a good lawyer or some kind of consultant who can kind of walk you through, because you are going to be taking a level of risk. The firms, and we were told flat out, we're not going to make this easy on you guys. I was flat out told that. So when you're making the change, it's a hostile change. So you have to be prepared for that.
Yeah, absolutely. So Manmeet, I'll bring you into this conversation. You're kind of focused on the opposite end of this regulatory landscape. For you, you're providing pathways, succession pathways for firm owners who are maybe given up on this fragmented regulatory landscape that we have in Canada. What are you seeing in the regulatory landscape right now? And what are potential sellers saying to you about how regulation is making them want to maybe exit or transition their firm to a firm like yours?
Yeah, great question, Joe. Obviously, the entire regulatory aspect is a bit of a hornet's nest at the best of times. And I completely agree with Colin's comment about the need for bringing expertise into the mix. The reality for me is the regulatory landscape isn't just on the fringe of decision-making criteria any longer. It's increasingly becoming one of the key drivers of deal criteria and timing. The alphabet soup of the environment we live in, whether it's acronyms on KYC, KYP, AML, CRM2, CRM3, they're creating a significant operational burden, especially for the small to mid-sized firms that don't necessarily have the expertise or the folks or the personnel within their firm itself. So once again, Colin's point, seeking a partnership or sophisticated understandings are going to be a key element. And it's not just the volume from what I've been seeing, but the complexity of these regulations that have largely been increasing. Some of this has been managed by operational platforms, custodians, but oversight and confirmations remain the responsibility of the PM firms themselves. And this is not something you can simply throw technology at. These are tasks that require time, people, expertise, or capital to weave your way through this regulatory framework. There's a number of shops in our country that don't necessarily have that capacity or personnel, to my earlier point, to look through these ongoing and fluid regulatory changes and ensure that they're properly implemented and monitored thereafter. So I don't see this trend reversing, and I'd put it as one of the top reasons that sellers are engaging in discussions. I'd say succession, technology, and regulatory compliance would be the top three that I've come across.
Yeah, that's really interesting. Noah, on that in particular, you're at the kind of cutting edge of the data. What is the average size of these firms that are coming to you asking to be registered? And what would you say is kind of the optimal for the amount of, potential pain and regulatory red tape that they need to go through?
Yeah, it's a good question. I think to some extent it depends on the market. Again, focusing on Ontario, Toronto in particular, I would say, anything less than at least a couple of hundred, 200 to 300 million it's going to be tight, right? There's just not going to be a lot of economics left over once all is said and done. I'm certainly I'm certainly aware of some people who are running firms with much smaller amounts of assets under management, but it's tough, right? It's tough for them to really make a living and to really scale properly. So minimum level of AUM is certainly helpful. Some people can grow it, but it's tough because I think to Manmeet's point, a lot of time is spent in administrative stuff, compliance stuff, whatever you call it, that doesn't generate revenue, right? And that takes you away from doing sales and things like that, and taking care of portfolios and otherwise growing the business.
I'm going to put you on the spot here, Colin. Would you mind sharing approximately how big you were when you went through the registration process?
We brought over, I think, about 800 million was our initial starting point. So that's kind of on the other side of what's practical. But it's a trade-off, right? Because I talk to the younger advisors, smaller advisors that have a couple hundred million. You can put the work in to grow it on a platform and then move it to a different platform. And that you're kind of redoing work. If you have a clear path ahead of you for growth and you've got a bankroll, you can afford to do it. Moving with less assets, is the right move. Because I've watched people say, well, yeah, I got to get to $1 billion before I move, and like 10 years go by and they didn't get there. Well, maybe they're never going to get there. But if somebody's on the path and they're growing aggressively, well, the sooner you growing on a new platform, if you've made the right move, like if you seriously can operate a better business on the other side, growing on the other platform should be easier, more efficient and effective, and doesn't set you up for a transition later. So I've seen it, like I agree with Noah, you probably can make it work in the 300 million range, but you're not going to get, that's not an economic incentive, that's a platform incentive. Cross 500 million and there's an economic incentive should begin to creep into it. But to really be able to do what needs to be done to keep up with some of the changes that we're facing, the $1 billion mark is really what you want to target, where everything can be a little bit more comfortable and you can be properly scaled and have the proper people on staff. And to the audience, it just depends on how fast you think you're going to get there and what your method is to get there and whether you're going to be successful. If you don't get there, you would have been more economically viable in one of the more traditional advisor relationships.
Yeah, that's really interesting. So actually that pivots us quite nicely into designing a distinctive value proposition. I'm going to start with you, Noah. You talked about this at the beginning of what you were discussing on the regulatory side of things and the time it takes to get registered. The fiduciary investment counseling framework is different to the rest of CIRO or MFDA. How can that impact what business models are actually possible for advisors to implement? And also, where have you potentially seen areas where the value proposition they're going after has meant they had more time going with regulators and engaging with them on the registration process?
Yeah, sure. Well, I'm going to push back a tiny little bit, only because, you can have a portfolio management business within a CIRO framework, right? And in theory, you shouldn't have, we don't want, I think as a policy issue, to have there be opportunities for regulatory arbitrage. We really don't. We would like, as a matter of principle, for them to be neutral. Now, the reality is they're not so much because the rules are fundamentally different, but because the cultures are different, right? It's a very different culture when you're dealing with the Ontario Securities Commission versus CIRO, for better or for worse. And I'm not saying one is better than the other. They're just different. As far as differences in business models go, I I have clients that can do certain things in a investment counseling framework that would be much more difficult within a CIRO framework. Like, for example, unitizing a strategy, in other words, a fund, right? That is theoretically possible in a CIRO framework, but you need an IFM somewhere. Maybe your dealer gets IFM registered. It's complex. It's not really meant for that, right? You also don't really see things like institutional portfolio management in a CIRO context. Again, in theory, you could, but it's just not really something that is done very often. I think, practically speaking, the real impact, is that in many cases, not in all, but often in many cases, the investment counseling firm tends to be a little more intimate, right? Either because it's smaller, or although there are some quite small CIRO dealers, but also because you have more, in general, people are they're less segregated in their roles, right? Again, there are exceptions to all of this, but in a CIRO dealer, if you're a portfolio manager, you're really focused on running your book of business, whereas in an investment counseling firm, you may be more involved in, developing model portfolios and administration and compliance and things like that. So that kind of creates a little more directness in terms of accountability and things like that. There are exceptions to everything I've said, and I know Colin has a different perspective, and probably Manmeet does as well, right? Given their two different business models. So I'd be curious to hear what they have to say. And
pushback is good. We're looking for friction here in this conversation, so the audience gets to see us arguing amongst ourselves. I'm going to turn to you, Manmeet, and ask you a little bit about this, just to follow on some of the things that Noah said here. I don't imagine getting registered was particularly hard for your investment counseling division. Having said that, though, you are pursuing a buy and build strategy. Is there any part of that value proposition that is more or less challenging to implement in today's world? And maybe even take us back to what is the strategy that you're pursuing at Wellington-Altus Private Counsel?
Sure. To answer the latter question first, the strategy that we're pursuing is flexibility to a large extent. The firm has a slogan, built by advisors for advisors. And, I will emphasize that being the case, regardless of the regulatory body it falls under. So, the goal is for us to have teams to partner with our firm, and to Noah's point, we're really agnostic of the side of the business they choose. Whatever model makes the most sense for them under that flexibility umbrella. If it's a CIRO advisor looking to create that institutional type portfolio, or we do have an IFM that Noah mentioned as well, to have a unitized product. That can be done on the CIRO side as well, but ultimately it's flexibility, taking a look at exactly what the strengths are of a partner firm, the needs are of a partner firm, and where those gaps are, and seeing what facets of those we can help out with. The private counsel space in this country is very fragmented, and there are a lot of challenges from a scale perspective because of that fragmentation. So what we're trying to do is solve some of these problems, which are very unique to individual firms and not a homogeneous type solution that applies to everybody. There are some key facets that are universal: compliance, operations, marketing, technology. Those are the areas that are the low-hanging fruit, I would say, and then come the nuances on a firm-specific basis of, whether that is succession, whether that is growth alignment, ancillary services like advanced planning, insurance, something of that nature, to really push a practice to the next level.
That's really interesting. Colin, I would love to understand, did you leave any assets behind because you were previously a CIRO firm doing, I imagine, discretionary and non-discretionary business, or could you move everything?
We moved everything we wanted. There were assets that stayed behind that just weren't a fit for the new platform. So clients that wanted to stay in a transactional relationship, but we just have no interest in that. We don't add any value there. And it wasn't something that we could support. Because we wanted to have a business model where our best ideas were in every client account. And if a client didn't want to take our advice, they shouldn't be paying us. So, but we did take the vast majority of the assets over when we did move.
Yeah, and I think that's a really interesting point that you pick up here. There will be decisions that you have to make that may impact the assets you bring over, but may make you better positioned for the long term. And that was the thinking here, Colin?
Well, rolling back into your question, because you asked a really stupid question about value proposition, and that's a dumb question. And it's a question this industry asks all the time. What we lost sight of in this entire industry and why we went off and founded our own firm, it's about what you value add to the client. Let's talk about the client. Now, the CRO world has barriers between the advisor and the client and doing what's right for the client. The CRO firms have barriers between doing what's right for the client and being there for the client. There are fewer barriers when you go the ICPM route. You get more autonomy and you're treated more like an adult. The CRO framework, the SRO framework, basically sets the advisor up. If the advisor does something wrong, the advisor is punished and the firm is okay. That's kind of a firewall between advice and the firms. As an ICPM accountable directly to the regulators, okay, we're now accountable for what we do. And we are given more credit and responsibility for how we structure ourselves. And they have oversight for that. And for us, moving out from, again, having a partner that was a manufacturer of product who was trying to help us all the time with software updates and new programs and this and deferred compensation based on internal product and all the rest of it, it was just noise we didn't want. And it was noise that frustrated us, and it was noise that got in the way of getting them and us to be able to pay attention to what really mattered. So for us, it was getting rid of as much of the noise as we can so that we can just sit in the room quietly and say, okay, what do our clients need? And it's allowed us to do stuff like pursue cross-border registration easily. So we were able to go down and set that up because we got clients with assets trapped across the border, and there's not really any good solutions. In a CRO, or if you're on somebody else's platform and you're trying to do that, that's too complicated. Many situations would not be able to deal with that quickly and effectively like we were able to do it. So we were looking for the freedom, looking for the responsibility, and being able to get really close to what's pissing our clients off and how do we fix that. We want to slap on mortgage brokerage. We need to improve our insurance brokerage. We want to do more tax returns. We need to bring some CPAs on staff. We have ultimate flexibility and freedom within all of the regulatory environments, and we have to make sure we're compliant with everything. But we get to decide what is enough and what isn't enough. And by not having external shareholders, we're not beholden to somebody for my quarterly reporting that I need to make my numbers this quarter. We're willing to do something that may pay off 2 years from now, and we can be patient with it and roll it into the organization. So the flexibility that you get under being an ICPM firm registered directly with the securities regulators, if you're properly resourced and you got the right people to deal with the regulations and you stay on side of everything, and that's a big if, you can work. There's a lot more that's possible if you behave that way.
Very interesting. So this is a question for all of you, and some of you probably have different perspectives on this, and I would like to have a good debate on it. If incorporation was available today in CRO land for the IROC advisors, do you think we would have more or less registrations for investment counseling firms?
Okay, I can tell you for the 4 years I was on the National Advisory Council, advisor incorporation appears in the minutes of every meeting, because if Andrew didn't have it on the agenda, I brought it up in additional business. And they've been talking about it for over 20 years. To answer your question directly, yes, there would be fewer people wanting to go ICPM, but I think that's completely wrong-headed. Setting up your own firm has got so much more to it and so many more values, but incorporation does make it a simpler structure on a whole bunch of levels, everything from raising capital to tax efficiency to being able to be flexible in your structure. Corporation is a big deal, but many advisors are just caught up in the tax planning available to them in a corporate structure, and many institutions now have got ways to kind of back advisors into having somewhat of a corporate structure that, under the harsh light of day, may have issues at some point. There have been some workarounds out there. But yeah, I think the short answer is if advisor incorporation was easily and freely available without restrictions to CRO advisors, there would be less interest in going through the pain of making the transition over to the ICPM platform.
Anybody else have a view?
Colin's got a great view on that. I would tend to agree with him, but the reality is, I think upwards of 30% of ICPMs in the country have less than $100 million in assets. So there needs to be a calculation conducted to see what the incremental benefit and the amount of change that's necessary to move down the other path would entail. So there's a break-even point, and I'm not sure if there's a universal calculator that is out there to see who would actually benefit from that incorporation versus it being more of a pain point than an actual benefit or a nuisance.
Yeah.
In my experience, tax and even economics in general, of course, they're always a consideration, right? I mean, I don't think any rational advisor would make a decision without taking that into account. But I can't think of a single instance where that's been the only deciding factor. And in fact, I don't even think it's the number one. Right? I think in most cases, really what's the number one deciding factor is, do I want to own my own thing, right? Like, do I want to have that sort of, even as simple as pride of ownership or the freedom that Colin alluded to, but also recognizing that there's a tremendous responsibility that goes along with that. There's a lot of headaches and a lot of stuff that in a more centralized environment, like the one that Manmeet works with, is becomes someone else's problem, right? And so I think I don't think that there's a one size fits all. I think it depends tremendously on one's goals and one's view and values and how one wants to spend one's time and one's knowledge of their own strengths and weaknesses, really. And that's where I see these being the most successful over the long term, where the decisions are being made for the right reasons and with a recognition of like, this is what I'm good at and this is what I'm not.
Yeah.
The other thing to recognize is that tax rules change, right? So if you're an advisor that decides that, okay, I'm going to go launch my own firm, and you start the year-long process, and 10 and a half months in, CIRO gets around to allowing it, and or there's a change in CRA rules and regulations that make it less attractive, you're kind of hooped if that was your only reason. And you don't want to let the tax tail wag the dog. Now, it can be one of the considerations, but you want to make sure that it's not the primary or only consideration, because those rules can change every year, both on the regulatory side and from CRA's perspective or the finance department.
Totally. And you can already see CIRO and CRA butting heads a little bit on it. So it's an interesting thing to observe.
Well, that conversation's going on a long time. And there's a big body of evidence that CIRO hasn't been trying that hard because it's not in the vested interest of a lot of the players. But they're kind of backed into a corner now because they've got the legacy issues that they've inherited. So they're going to have to come up with some kind of compromise, but it is going to be a compromise. I think anybody who's sitting back and waiting for CIRO to carte blanche allow free incorporation for anybody who's a registrant, I can't see a way forward for that, because that'd be too disruptive to the major players.
Yeah, absolutely. So one of the reasons I asked that question is because the current proposal for incorporation for CIRO advisors would restrict who could be in the cap table, who could invest in those underlying businesses. And so, Manmeet, I'll turn to you, because it's widely known that Wellington-Altus is private equity backed. You have a number of minority investors in your business, most recently at $1.5 billion valuation. So congrats to you and the team on that. But how does that funding source and profile help you be successful in your growth via acquisition strategy? And then how does that help you sort of stand out to sellers as a well-capitalized buyer?
Well, I think the private equity interest, first off, Kelso, who was the recent private equity investor that you're referring to, Joe, has been a great boost for us reputationally, first and foremost. I mean, to your point, that validated a $1.5 billion valuation for the firm. And especially when you see U.S. private equity firms come north of the border and make a $400 million investment in a Canadian wealth management firm when they have a plethora of opportunities south of the border, kind of gives the street a notification that we're doing something right. They see our strategy working, our roadmap moving forward, and not only, taking a look at the historical growth, but an assumption of accelerated growth going forward. So, the opportunity to have conversations with folks that have seen this sort of thing transpire, understand the capitalization benefits, understand the liquidity that we work towards in this case to, reward some of our initial investors and longstanding our advisors, really exemplifies what we went out to do in ascertaining some of this private equity funding. So awareness is what I would categorize it as. People are posing questions to us and asking about this more so than they would have, with a silent investor or something that was smaller in its nature.
Yeah, that's really interesting. And Colin, I think I understand your model is different. You're not pursuing institutional partners in your business, and as I understand it, you're bootstrapped. Maybe you could share a little bit about your funding model and how you're different to maybe a private equity backed strategy like the Wellington-Altus one.
Well, yeah, and again, I think private equity is the root of most evil in the world, and we've been in the room with them. So we were bidding on a US RIA, and we went to 9.5 times EBITDA, and private equity came in the mid-teens. In order to make that deal pay for them, they would have had to do unspeakable things to that business and those people. Like there was no financial roadmap forward for them to give any kind of consideration to the value advice to those clients or to the people involved in the deal. Now, I'm not saying all private equity is evil, but it is where evil lives. Now, I'm sure the private equity on this call is perfectly fine and legit, but it really does change the model. And I've watched very, very unsavory things happen, where they, I was talking to an advisor one time who had just signed a deal with a firm, and he was all upset. He had to go back to the office and explain to his 20-year employees why they had to sign new employment contracts that had no seniority on them, because that was the part of the deal he signed with the private equity firm that was buying him out. And to him, it was no big deal. He was cashing a big check and he was really happy, but he basically had sold all of his employees up the river because they were all losing their seniority, and they were all had 1 week notice contracts given to them. And those are the kind of steps that happen when you start maximizing. And they are deep pockets, but we've been in the room saying, great, your pockets are deep. We'd like some money. That's great. We're going to charge you 25%. I could do a credit card advance and get money cheaper than that. Like the pockets are deep, but the expectations are very high, and it can very quickly change your business model. So we're 100% employee owned, and we built the firm on buying businesses across Canada, the dealer structure. So there was vendor takebacks involved and some financing from the firm. So we have used some cash flow lenders, like we were using Canadian Western Bank, and we were very sad when they got taken up by National Bank, because that's changed that relationship. But there are cash flow lenders out there once you get into a corporate structure. One of the things about becoming a full standalone shop and being a corporate structure, it changes your access to various lenders and makes you more attractive. So there are cash flow lenders that are out there. But just be aware, if you put an outside investor at the table that has expectations, because I've had conversations with CEO of other firms, and we're talking about innovation and change and things we want to do. And like the person I'm talking to kind of shrugs their shoulders and says, yeah, but we're profitable. Why would we invest in that? It's like, well, we just agreed it was better for the client. It was a better experience for everybody. He goes, yeah, but that would be expensive, and we have to hit our numbers every quarter. That was the actual conversation. It's like, I don't want to ever be sitting in a room where I've got a really good idea to make the business better, and I can't do it because I'm already too profitable, right? I think that's a recipe for ceasing to be an influence of change in the industry and getting to a much better place 5 years down the road. And I get it. It's Pollyanna. It's pie in the sky. And I'm the one guy in the room not trying to maximize my paycheck in the short term, because I think if you do it in the long term, there's a different path forward. And it's great. We need someone to trade against. We need a marketplace where there are different actors that are prioritizing different things. And there are people more senior in their career who need to cash out. And there's different ways forward for that. But the methodology that we've adopted is more about being internally employee owned and controlled, taking a longer term view of things and being willing to invest in things that don't have an immediate payback, because it just is part of the myriad of things we're trying to do for our clients. So it's just a different way and a possible way forward.
So I hear from a lot of firms that, our chartered banks have no incentive whatsoever to lend money to firms like yours, Colin, because you plan to compete with them and take assets from their platforms. Doesn't that sort of push you down the route of Manmeet's funding model, of Wellington-Altus's funding model, eventually, if
I,
all of your funding paths are locked?
I think those people have an inflated view of themselves. I'm pretty sure none of the banks consider me a threat. And this business, they don't. The people you're talking to are the people who are getting paid to lend money. So they're going to go and try to lend you money because they have to hit their target. So there's very much a self-interest in there. I can't imagine getting to a stage where the Royal Bank's going to look at me and go, "Oh, I don't know, we're afraid of you." I aspire to have that as a concern. But I don't see it as a realistic concern in the near term. And listen, like I said, private equity as a group, yes, I consider it evil. Individuals, there's fantastic private equity firms doing fantastic things. I can absolutely say that is out there. But I've seen way more bad things happen in the name of private equity than I've seen good. So it's just a very, very careful, and understanding it changes the expectation. Because again, one of the conversations was somebody said, "We got very deep pockets. Great, we'll take some money. Yeah, we're going to charge you 25%. That's loan sharking, and for that they want ridiculous guarantees. So it's just very deep pockets in some of these pools, and they're also in a business. The private equity people, they have a hold period, and they've got responsibilities to their investors. Now, those evergreen funds are becoming newer and more common and all the rest of it, and it is a moving landscape. But if you have a real passion or dream or something that you want to execute on, if you allow somebody else at the table that you're accountable to, then you have to listen to them, and it's going to change your decision making and put more of a financial lens on things.
If I can make one comment, Joe, I don't disagree with Colin, but it really emphasizes taking private equity capital on a blind basis. I agree with Colin. It's running a certain degree of risk. Finding cultural alignment and a specific private equity fit is going to be crucial in any kind of an investment. So it's not just, hey, we need capital. It is a situation where we want to structure a partnership where individuals are coming to the table with not just capital, but knowledge and assistance in furthering a business plan.
Yeah, I think that's really interesting. And I'm glad that you're having this debate, because there is a nuance to Wellington-Altus's strategy, which I actually really like. Minority investors with no obvious controlling party does potentially address some of the things that you're talking about, Colin. Mm-hmm. And so I think sometimes private equity is tarred with a general brush. And I do think that the hats do need to go off to the Wellington-Altus folks who have actually designed something that is pretty innovative, and they're picking people to go into that ownership stack that actually are different and think differently. Let's turn to technology, because this is an area that is obviously changing and evolving incredibly fast. And I'm going to turn to you, Noah, first, because I think the regulatory element of this is a really interesting thing to zero in on. We're seeing a lot of new AI tools. We're seeing the threat of AI tools maybe even taking over advisors' roles. But certainly on the productivity side, there's a lot of things available to advisors and firms to help them be more efficient and do more with less. What are some of the regulatory aspects of that need to be considered?
Sure. Well, I think AI is an incredible development. And I think one of the things that's so exciting about it is how it continues to evolve. The tools that are available right now are different from the tools that were available 2 months ago, right? Which is pretty amazing. So the pace of change is fast and is going to continue. And I think that, whatever you think about it, you need to be aware of it and to understand it. From regulatory perspective, I think it's first principles, right? Do you understand it? Can you supervise it properly? Do you have appropriate cybersecurity controls over it? Can you ensure that you're not leaking, confidential or private information? At the end of the day, you can't abdicate your responsibility to it. And I think that's a great temptation because of how powerful it is, right? It's sort of like, you can sort of shrug your shoulders and say, well, this thing can do the work better than I can. That's not going to be acceptable to regulators. It's also not professional, and you're certainly not meeting your fiduciary duties if you're doing that. That said, to the extent that AI can be used to, automate low-risk tasks or other things that increase efficiency, I think one would be foolish not to use it. But I think that ensuring that you can explain the decision making, that is essential, right? You probably want to use some kind of closed loop system. In other words, you don't want to use a system that is sharing your confidential data to train the model, or in other ways. There are systems that use the newest models but keep them in a closed loop way. So those are things worth looking into. Incorporate it into your business continuity plan, your cybersecurity incident response plan, right? Because if these are going to now occupy essential roles in the organization, you need to have a backup plan for when they stop working. And ultimately, I think that you want to be responsible for it. I think like the biggest risk is not using AI aggressively. I think the biggest risk is using AI casually, right? Without a very clear strategy and supervision / control mechanism.
Very interesting. Yeah, I think I understand what you mean by that, but I guess what you're indicating here is that people who don't have a policy and a strategy in place around using AI could get caught out with data privacy and things like that.
Or worse. I mean, look, the regulators came out with some guidance a little while ago. I think it's already outdated. It's worth having a look at. I don't know if it was official guidance or sort of something in between. It's kind of a position paper on use of AI, but I thought parts of it were very good, and I thought parts of it sort of didn't make sense, right? Like there was one sort of point where it said, well, you've got to tell your clients exactly where you're using AI in your business. And I just thought, that's not really necessary.
Or possible.
Right? Yeah, that's a great point, Colin. So yeah, I mean, I think monitor it, stay on top of it, but ultimately just don't stray from core principles of supervision, of prudence, of good oversight, client confidentiality, all those key things.
Manmeet, you talked about technology being one of the top 3 reasons that smaller firms are engaging with you. What are you doing that's different to those smaller firms? What do you have access to that they don't?
Well, I think from an access standpoint, everybody has access to everything. Obviously, there's a capital investment that would need to be made to garner the larger scale efficiency aspects of a broad-based end-to-end system that we can put in place, but a $200 million shop may not be, and not just from a capital standpoint, but from an integration and expertise standpoint, might be beyond the scope of their existing firms. So we're presenting that option. I mean, ultimately the industry is filled with, Joe, there's fragmented systems, there's manual workflows, integration gaps. Noah mentioned cybersecurity. There's vendor management. Scaling and change are 2 key components that always rear their heads. So the reality is, I don't think there's a one-size-fits-all strategy in this space, and forcing a square peg into a round hole is probably a recipe for some degree of disaster. So what, I mentioned earlier, we're looking at a flexible approach. So we're trying to find ways to accommodate firms that have no end-to-end structure or limited end-to-end structures to adopt what we're putting in place, all the way to firms that have significant components in place, but there's just some gaps or some fragmentation, and they'd like to keep components A and C, and they're in love with their portfolio management system. Can we work around that and build the other aspects of the framework to allow them to make their practices more efficient and grow without having to worry about all of the underlying IT and compliance tasks? And that's what we're really focusing on, is that key, flexibility message. And let us know what you have, and we'll show you ours, you show us yours, and we'll see if there's a happy midpoint that makes sense.
And Colin, what's your experience been as a new registrant buying technology? Is there a plethora of options available to you? Are there just a few? What's your experience?
It's growing exponentially, and one of the reasons, actually, as Amit described, one of the frustrations that drove us away from the dealer structure is exactly what he described. The dealer structure is trying to have multiple ways of dealing with technology. So by being our own firm, we can do it one way. Like we're on our third iteration of AI note-taking tools within our structure because it's all aimed at one thing. We're not worried about implementing something that needs to work for big advisors, small advisors, different kinds of advisors. So the nimbleness of being at the size we're at and having enough heft that we have some expertise on board, the democratization of some of these AI tools, like for $20 a month, you can get a ChatGPT. And I saw a demonstration where a publicly listed firm took through 2 years worth of financials, dumped it in and asked it to do an SEC filing, and they did it in 30 seconds with 15 pages. And the CFO said that's 3 months of work for my department to produce that same filing. So that's the room we're in right now. It's ultimately flexible. So in a world where almost anything is possible, how defined can you get what you want? And then you can execute on it. And the problem, and again, the advantage of the younger firms and the smaller firms is we're kind of laser focused on what we're trying to get done. So we're not trying to come up with a solution that can handle 6 different business models. We need a solution that supports one business model. So as we don't have the same money and have to put a big data center together for sure, but we also have a much narrower target that we're shooting at. And if we're smart, and the world will tell us over time how smart we are, we'll be able to hit the target. So it's 2 different games, and as with most open markets, it's great to have people to compete against and trade against, and I have an alternative for.
Yeah, and actually, why don't we stay with you, Colin, to talk about growth strategy, because you've touched on it a little bit and left some breadcrumbs there for us to know what your strategy approximately is. But I think a lot of folks, when they do set up a registrant, their goal is to grow potentially faster than they have been with the roadblocks out of the way. So where are you seeing the opportunities to grow both organically and inorganically?
Well, it's interesting. This question often gets asked as which one are you going to choose. I think that you can do both. Right? So we try to have an offering out there, and we do have an offering out there that generates a lot of referrals coming into us. And one of the things we could do as a firm with a single business line, we did, I think, 1,400 pieces of media last year that went out. And so we have a constant message going out across the whole firm, and it's going through all of the social media and all of the other connections that we have. So we're generating just some inbound calls like that, but also our platform is different, and that's attracting phone calls from advisors who want to get out of the old model, and they like our version of the model better. And those opportunities are now coming to us internationally as well as across Canada. Now, our challenge is that we're not hunter-killers, and for those who want to get paid for bringing an account in, we don't have that model. So maybe we appeal to 2% of advisors, maybe we appeal to 6%, maybe it's 12%. I don't know what the number is, but we have an audience, and as we get more known and people hear the story more, we're getting phone calls, and it's interesting to watch that it's not just inside of Canada. So the phone rings, I'm going to take the call. Like if somebody calls up, says, "Oh my God, that's great. I want to be part of your model." Okay, then we'll have a conversation. But in the meantime, we're still putting out social media every day. We're still doing client events. We're still doing joint events with law firms and accounting firms, and we're still supporting cross-border planning firms, and we're still doing all those other things. I don't think that you need to focus on one or the other. I think if you are thoughtful about how you organize things, and again, having a business model that's focused rather than a business model that's trying to accommodate a whole bunch of different ways of managing money and a whole bunch of different ways of doing insurance planning and a whole bunch of different ways of all these, we can be a little bit more focused. So I think we can more efficiently execute both organic growth and being available for mergers and acquisitions when they happen.
Yeah, and Manmeet, in your case, you build a dedicated corporate development team. You have specialist resources. I always tell people M&A is pretty distracting as a strategy. It is going to absorb a lot of your time. How do you address that time and resource need at your firm, and what do you need to be successful at a largely M&A-led strategy?
Well, to your point, Joe, obviously we do have a team in place to take care of a lot of the due diligence work, which is time consuming. It's taking folks away from their core day-to-day business. But fortunately, it's not an item that takes place in perpetuity. It's a one-time effort. that is looking at the financial impact and the cultural alignment too. What would we need to be more successful in that, Rain? There was a quote I heard, and when you're bringing people to the table, it's funny. A lot of folks that we've spoken to have said, you know what, I want to think about something like this, but 5 years from now. And it's probably been a rolling 5-year period for a while. And the reality that somebody brought to my attention was it could take up to 5 years to appropriately find a buyer, that alignment, the due diligence, work through an integration plan. So the planning really needs to start today. That's what I would say that education and knowledge would be incredibly helpful. It's not a 5-year plan starting in 5 years. It's a 5-year plan starting today that'll see fulfillment within the next 5 years, and there's a real need for those succession strategies in this country and acknowledgement of that need, but very little planning for that eventuality that's come into play, including discussions with folks like you. And I think that's important for individuals that might not necessarily be at the cusp of making a decision, but the reality is there is going to be a decision necessary in some form or another down the road. Nothing's precluding her from starting that conversation today, and it's in their best interest to do so.
Yeah, absolutely. And I see that frequently. People in our industry who run IC firms say, look, I do valuation every day. I pick securities for my clients' portfolios. And I say, that's very interesting that you have that knowledge and experience. Well done to you in the public markets. But most of the firms we deal with are in the private markets, where the data available to you to make astute decisions about the valuation of your business just isn't available. And so maybe fortunately or unfortunately, certainly fortunately for me, I happen to be across the information, and I'm sure you do, Manmeet and Colin as well, and to some degree as well, Noah. I'm sure you're involved in a lot of these M&A-led strategies. The issue is a lack of information, and for many people going through this transaction for the very first time. Mm-hmm. And it's an emotional moment where you can get lost in it, and you sort of need somebody with a steady hand to take you through the process, who's been there and done it multiple times. We are right at the time, and I know, Colin, you wanted to add something there, but sadly we are right at the hour. LinkedIn sadly also had a technical issue with us. We have recorded, and we will put this out later, but we did not end up going live on LinkedIn. So I allowed us to go all the way to the hour with no questions. But I'm certain that anyone watching the playback here will be interested in asking each of you questions or engaging with you afterwards. What's the best way for each of you to get in contact? Is it LinkedIn? Would you prefer people reach out directly to you via email? What's the best way, Manmeet?
LinkedIn is great. Happy to post my email address as well. It's pretty straightforward, manmeet.badia@wellington-altus.ca, but LinkedIn's always a good vehicle, Joe.
And Colin?
LinkedIn's fine. I'm on LinkedIn regularly, so I can respond to anybody on LinkedIn.
That's great. Noah, how about you?
Yep, I'm active on LinkedIn, and I respond. My email is noah@rennoco.com, RENNOCO.com.
Okay. Thank you for a very insightful conversation. I'm sure we could have spent several more hours talking about the nuances of the business and of starting and scaling an investment counseling firm in Canada. But for now, we have to cut it short and leave the audience with some more to learn about each of your businesses and business models. And I thank you, and we'll see you on the next one.
Thanks, Joe.
Thanks, Joe.
Thanks a lot.